Thank you very much. Thank you, Professor Silvestri. Thank you, Ambassador Neri Feroci, for this invitation. I am very glad to be here to address an issue which is really in the making and from which depends a lot of our community and union. The exit from the euro crisis is the subject that is in the back of this intervention. I'll try to summarize what have been the main challenges that we have faced in the last few years, and then I'll move to say a few things about this project in which we are very much working. I'll try to do the following. I'll say, first of all, a few things about the crisis, from the financial crisis to the sovereign crisis, what has brought us there and how we have dealt with that. And then I'll move to the topic of this morning, which is really how to improve the EU governance and somehow the euro area ability to withstand a substantial risk, the risk that many have thought as possible, and we are clearly acting against, of the euro breaking up. One of the stones, the important steps that in this process is this work on making the euro area truly unified, a single area. A single area means improving our governance, working on the ability to have a single market, true single market for trading and services, and a real single financial system with a single supervision and so on, in the prospect of this being one of the stepping stones toward a fully fledged union. I'll read what I'll tell you for a number of reasons, among the others, because governors, as you know, are always at the risk of being misinterpreted. It is because they are not always able to explain themselves very clearly, but it is better to have in the writing what you say. At times I may make some comments, but obviously at the end of this short intervention I will be very glad to answer questions that may be posed from all of you. So the euro area suffered two recessions. And this has taken place in the last 5 years. GDP contracted for 5 consecutive quarters, starting in the spring of 2008. The fall came to more than 4% in 2009. The subsequent recovery was short-lived. The outbreak of the sovereign debt crisis in mid-2011 was followed by 6 quarters declines, and in 2012, GDP was still close to 1.5 percentage points less than in 2007. The signs now are that the contraction is drawing to a close. GDP resumed moderate growth in the second quarter of the year, reflecting the expansion of exports and progress in domestic demand, and the confidence indicators improved somewhat over the summer. Actual and expected inflation remain subdued, and they are well below 2%. However, the timing and strength of the recovery are still uncertain. The resolve with which European and national authorities continue to implement the reform strategy devised to deal with the crisis will be decisive for financial conditions and for business and consumer confidence. Externally, the slowdown in the emerging economies and the recent geopolitical tensions in the Middle East threaten to undermine the prospects for world demand. The crisis did not hit all euro area countries in the same way, and the recovery is correspondingly asymmetrical. In Italy, the recession has been longer and deeper than in most other countries. I'm not going to say anything on the reasons, but it is there is a lot of analysis behind that. Most of that is basically a very lagged response to the fundamental changes that have taken place in the last 20, 25 years on the geopolitical side, on the demographics, and on technology. Last year, output was almost 7% less than in 2007. In the first half of 2013, GDP diminished again, but at a slower pace, with exports still providing the main stimulus. The latest indicators are consistent with gradual improvement, and the decline in output should come to a halt in the coming months. The downside risks to this scenario are compounded, however, by investors' concerns about possible political instability. The spark that ignited the sovereign debt crisis in the euro area at the end of 2009 was the unveiling of the dramatic state of the public finances in Greece. I mean, you will forgive me if I say things that are so familiar to all of us, but it is just to put everything in context and then draw some conclusions. But the tension soon fed on the economic weaknesses of other member states. That is, weaknesses on the macroeconomic side, imbalances there, real estate bubbles in some countries, distressed financial systems in others, and high public debt. The crisis became systemic in the summer of 2011, with the announcement of the involvement of private investors in restructuring the Greek debt, which made the market suddenly aware of the implications of the no bailout clause in the EU treaty. These events laid bare the incompleteness of the European construction, the euro being a money without a state. The spreads between the government bond yields of the fiscally weak countries and the German bond soared. A serious crisis of confidence in the very survival of the single currency ensued, with adverse consequences for the real economy. The situation deteriorated most severely in the banking systems of the countries most directly affected by the tensions, whose perceived credit standing soon aligned with that of their sovereigns. Wholesale funding conditions deteriorated sharply. Cross-border interbank lending all but dried up. There emerged a perverse loop between fragile public finances, weak economic performance, and deteriorating bank conditions. Given the risk of severe credit tightening, the Governing Council of the ECB took resolute action, and we had two special refinancing operations in December 2011 and February 2012, with which the European system supplied the European banks with about €1 trillion in 3-year funds. Net of the funds reimbursed in other refinancing operations, it amounted to 500 billion. The liquidity injection was effective, and sovereign spreads dropped while the wholesale markets revived. Europe's response to the sovereign debt crisis has been twofold. Domestically, to rein in the risk of the unsustainable public finances, individual countries have committed to prudent fiscal policies and structural reform to enhance competitiveness. At European Union level, to dispel the fears of the euro breakup and what has been called the redenomination risk, that is, countries going back to each one to their own currencies, a reform of economic governance has been undertaken. National action on the sovereign debt crisis has been heterogeneous. Fiscal adjustment was indispensable in the more economically fragile countries, including our own, to ward off the risk of losing access to the market, which would have precipitated the crisis. Its negative short-term effect on economic activity was the price paid for averting more serious consequences. With the benefit of hindsight, it is clear that the reform of European governance was long overdue. The long dormant process was effectively set in motion by the sovereign debt crisis, and despite hesitancy, overlap, and redundancies, within what I think is a very short span of time, definite progress has been achieved. Together with the efforts at national level, the reform of European governance has begun to rebuild trust among member states. The strengthening of the budgetary rules, which has reinforced existing commitments and made them more credible without imposing more demanding targets, this is an issue that we may deal with. There are people who are convinced that the new the changes in the budgetary rules are going to have a substantially negative effect. It is basically making more effective what has already been agreed upon in the treaty. And the extension of multilateral supervision, this is a new thing, to macroeconomic imbalances, have accompanied the institution of mechanisms of managing sovereign debt crisis and paved the way for discussion with a view to deepening European integration. Until recently, Europe lacked the tools for managing a sovereign crisis. Between 2010 and 2012, EU countries disbursed some 280 billion in loans, that is not bailout, is loans, to their partners in difficulty, either directly or through the newly established common financing instruments, the FSF and the ESM. Italy's contribution amounted to 43 billion of euros, which according to official estimates will rise to more than 60 in 2013. The European reforms are still in the making. Their full payoff, as well as the reward for national efforts, will come in the medium term. In the meantime, the distortions still affecting the financial markets could undermine the transmission of monetary policy and jeopardize the entire process. And this is a risk that materialized last year when sovereign spreads in the spring started widening again. By July, the differential between, for example, 10-year Italian treasury bonds and the equivalent German bonds had once more exceeded 5%, 500 basis points, against the value of about 200 points that was estimated at the time by many, among which the Bank of Italy, to be consistent with the two countries' economic fundamentals. The ECB Governing Council reacted by announcing a new set of interventions, which are called outright monetary transactions. And as everybody knows, it was only announced, it worked, there was no use of it. This may be something that can be discussed in the questions and answers. But this is a new method of intervention. Not only is used when something very serious happened, like the situation that was developing in July last year, and it is intervention on secondary markets for government securities, with the purpose to counter excessive increases in sovereign yields, where they stem from a particular risk, that risk that we call redenomination, that the euro breaks up. And the spread increase implies that interest rates are higher than they should normally be, because in the markets, operators, investors, savers are trying to hedge a particular risk. This is the risk that we are discussing about. And this would distort monetary policy transmission. Because of this distortion, which is documented, and because the fragmentation of financial system makes the transmission complicated, these interventions are fully within the Eurosystem mandate. The announcement of these transactions produced immediate benefits, and medium and long-term yields in the countries under pressure decreased. The fragmentation of markets along national lines was attenuated. Now, these were made possible not only by the credibility of the Eurosystem, but also by the very process of reform they intend to protect. And this means that the Eurosystem is basically building a bridge between the current situation in which the credibility of the euro and of the system at large, of the area at large, is fully restored and maintained in the years to come. But it cannot substitute to the main interventions that are the steps towards that objective, which are basically political interventions. And what is important is that the fears of euro reversibility are linked in the first place to concerns about the sustainability of the public debt and the competitiveness of some member countries. For this reason, the activation and continuation of OMTs are subject to specific commitments regarding the public finances and structural reform as part of assistance programs. Economists have a way to put this that I find useful. There are two objectives here. One is to reduce the risk of default of a country, and the other is to reduce the risk of breakup of the euro. These two objectives need two instruments. The first is national policies. You put your house in order, you do what you have to do on the public finance, on the labor market, on the structure of the economy. The other is you put your union in order, that is, you go and make it clear that the process of European unification continues and it is reinforced. Where is the European Central Bank? Nowhere there. the European Central Bank is fully convinced that the process is going on, but knows that the markets need time to acknowledge for that, and therefore provides some space for that process really to go on. And this space is in the interest of the ECB, because its mandate is to maintain price stability, which works both ways, on the inflation side and on the deflation side, and there are risks that this may take place if it does not intervene, and so intervenes that. In this way, it helps buying time for this process to accelerate, but it cannot substitute that, as I was saying. Now, and there is another problem. We have these two instruments and two objectives, but once the ECB intervenes, we decide to intervene in the market, countries may feel that everything is solved, and I was saying is not. If they feel that, they may reduce their endeavor to act against the first risk, that is the fact that the house is not in order, and therefore they may contaminate the process and make the second risk build up. This means that the two instruments are complementary, they're not substitute, but there is interdependence between the two, and this is why the conditionality is introduced, so that the ECB intervenes provided that the default risk is controlled by proper action at the national level. And this is the reason for which the activation and continuation of OMTs are subject to specific commitments regarding the public finances and structural reform as part of assistance programs. The financing of the programs within the ESM resources is an incentive to strengthen the governance of the Union further. I'm not going in detail about the ESM, the German problem, and so on. This is a clear issue. We should recognize it. It is not that we put it on the side. As I was saying, the interventions by the ECB are legitimate. The nature of the ESM is, in this case, not of bailing out, but helping solving a problem at a cost. But I understand that there are issues that have to be still clarified at the legal, constitutional, and so on way. But if there are problems there, they have to be solved, not really we should allow renouncing the use of instruments that make a lot of sense and are, as far as we are concerned as central bank, fully legitimate. Now, monetary policy can guarantee stability, as I say, only if the euro economic fundamentals and institutional architecture are consistent with it, and the financing of the programs, as I was saying, with the ESM's resources is exactly an incentive to strengthen the governance of the Union further. Now, confidence in the irreversibility of the euro is the key. In the short term, the effective use of ESM resources will preserve the progress made and safeguard the rights and the efforts of those who have helped to develop the instruments of financial support. The OMT announcement prevented the financial collapse, and this could have had potentially ruinous consequences for the European economy. All the member countries benefited, not just those at the center of the sovereign debt crisis. However, to ensure stability over the longer run, the effort to reform the European governance has to be stepped up, and it has been. The subsequent stages are outlined in the two reports, one by the Commission and the other by the President of the European Council, which has worked on this closely with the President of the European Commission, the Eurogroup and the ECB, and they have been presented last year. Both documents envisaged a banking union, the introduction of autonomous fiscal capacity for the whole euro area, a common budget, and they set the scene for the eventual political union. I mean, it is clear that, in my opinion, that this has to be a final objective. We should be realistic and obviously not claim that this is behind the curve. But what we have absolutely to avoid is to go zigzagging or make a reversal, because in that case, clearly the consequence for all these stepping stones are very severe. A keystone in this of institutional reform, the banking union is crucial to break the perverse feedback between sovereigns and domestic bank systems. It has three key components: a single supervisor, a single bank resolution mechanism, and a single deposit insurance scheme. In the summer of 2012, European leaders decided to give priority to the construction of the first component, which is the single supervisory mechanism. This comprises the ECB and the national supervisory authorities. For the largest banks, it will be based on strict integration of European national structures. For the others, it will involve the direct responsibility of national authorities under common guidelines. The ECB will retain the right to take over direct supervision responsibility where circumstances warrant. Now, this is a far-reaching institutional innovation and will require an organizational adaptation as far-reaching and at least as complex as that leading to the single monetary policy. The delicate launch phase will require substantial investment in human resources and technical infrastructure. The national supervisory authorities' workload will not diminish, as we strive to build a unitary new mechanism from frameworks that differ in many respects. The preparatory work is proceeding at the greatest speed compatible with the challenges of the task. Building on the technical experience and reputation of national authorities, the SSM will have to ensure a supranational vision. Supervisory practices within the euro area are quite heterogeneous. It is vital to avoid any lowering of standards and instead to converge on the best practices in supervisory methodology, in modeling and assessing banking risks. This will ensure early warning of emerging instability at individual banks and at a systemic level. And we attach special importance to aspects which are fundamental part of a tradition of the Bank of Italy, such as the central role of on-site inspections, methodologically robust quantitative analysis, and close interaction with banks. If successfully managed, the single supervisory mechanism will bring substantial benefits to the single market. It will improve the effectiveness of monetary policy transmission, counter the ring-fencing trends observed in the last years, fostering financial integration, facilitate comparison between banks and banking systems in different countries, and improve in this way the monitoring, control, and mitigation of vulnerability factors. Now, work is also continuing on the single resolution mechanism. You may have read a few reports yesterday, the day before yesterday, and so on. Now, this is the second component of banking union, and it is fundamental to make that a success. You have to supervise. Then, if a bank fails, it may fail because supervision is not really fully effective, but most of the time, the supervision cannot impede a crisis of a bank. It can intervene in reducing its consequence, in preventing some, but there will be always a failure now and then, and we have to be careful that these are not systemic. But the point here is that once there is a failure, you have to resolve it. And if you don't have common instruments to resolve it, then there may be vicious circles, and which may make the exercise really a danger. So what we have with this single resolution mechanism is to align the responsibility for supervising banks and handling crisis. The Bank Recovery and Resolution Directive is intended to harmonize heterogeneous national practices, rules, and tools for bank crisis management, and keep rescue operations from being financed with public funds. The directive lays down a number of preventive measures, together with rules for timely intervention and resolution, including the bail-in of bank creditors. A fund to be financed by the banks themselves will be earmarked for bank resolution. The European Commission has recently issued a proposal for regulation, which should be fully operational in 2015, to institute a single resolution mechanism under a single resolution authority and with pooled resources. Concerning the third component of the banking union, there is also a draft directive which has been prepared to implement a common network of national deposit guarantee schemes by the end of this year. Now, the institution of this ESRM, that is the resolution mechanism, must proceed expeditiously with appropriate negotiations with national and community authorities. It's going on. We are aware of the complications, and we know that they have to be sorted out. But once the mechanism is fully operational, the availability of adequate resources will allow the cost of crisis to be divided between the bank's shareholders, the creditors, and the banking systems as a whole. During the transition to this, the risk of a vicious circle between a fiscally weak sovereign state and its fragile domestic banks persists. The ESM, that is the mechanism that provides the funds, will only be able to directly recapitalize banks after the effective entry into operation of the SSM. Now, this recapitalization, it has to be clear, is not a gift to banks, because this is sometimes said, how can we use taxpayers' money of a country to give it to the banks of another country? There is a big problem there. And the working of this is really to somehow, in the aggregate, to restore the viability of most banks and obtain a remuneration of the capital invested. Assume that you are in the UK and you have a major crisis and you nationalize a bank. Well, the objective at the end is to put it back in the market. So, in a sense, you put money in advance, but at the end you want to restore and regain the money. The working of this mechanism has to be such that at the end this is profitable, and this I think is crucial. There remains now, as we move towards the possibility of using the SM, the possibility of using these funds indirectly, as it has been the case in Spain, by means of loans to member states. But this would bear on the public debt of the countries concerned, it would increase it. And this would bring back the bank sovereign loop back into the picture. With a view to the launch of the SSM, the ECB and the national supervisory authorities are working to undertake a comprehensive assessment of the soundness and soundness of the significant euro area banks, those that will fall under the direct supervision of the CSM. This assessment consists of thorough analysis of each bank's risk profile, comprising an overall balance sheet assessment, which we call BSA, including an asset quality review and a stress test. Newspapers are full of discussion of these issues now. The exercise will also cover other relevant aspects of banks' business, including leverage, corporate governance, and organization. We are more than 100 banks that are going to be moved over the next year under a single supervision. And the exercise, therefore, is extremely complex, important. It has to be very serious, very transparent. It has to convince markets of the ability to withstand windfalls. The comprehensive assessment is designed to make sure that the Euro main banks are managed in a sound and prudent manner, helping to dispel market concerns of their soundness and risk profiles. Significantly, from the outset, the assessment will also foster confidence in the SSM itself, reinforcing mutual trust among participating countries. It will therefore be a fundamental step in normalizing wholesale markets and restoring the banking system to its fundamental role of supporting economic activity and growth. In order to attain these objectives, the comprehensive assessment must be completely transparent, as I was saying, as regards not only results, but also process and methodologies. The appropriate involvement of external reviewers may enhance the credibility of the exercise. Attention must be obviously paid to potential conflicts of interest and problems of confidentiality. And also, level playing field issues among participating banks must be avoided. Now, the design of the balance sheet assessment must recognize that national accounting and supervisory practices differ radically, especially in the definition and measurement of non-performing loans. The European Banking Authority is working to make definitions uniform across systems and has recently issued a consultation paper on the matter. This is a step in the right direction and should be finalized in time for its results to be used for the BSA. This, in any case, requires a de facto harmonization of the non-performing loans definitions. And national practices also differ substantially in the measurement of risk-weighted assets, which is the denominator of regulatory capital ratios. So now, I mean, a bank has to have a particular capital ratio, say above 8%, above 10% in current practice and so on. It is a ratio of capital with the capital it has at its disposal. There are various forms of capital. We also discussed which forms should be allowed and which not. In certain cases, these are not fully usable. And the denominator is not the total assets of the bank, but are the assets weighted according to the different risk of each one of them. And these weights differ across banking systems. We have to unify them, and we have to order them on a scale that really makes sense. For example, derivatives at times are plain vanilla. They have not major risk. Other times are very risky. We have to distinguish between the two, and so on. Now, the differences in the models used by banks to compute capital requirements or in the approaches adopted by supervisors for validating them may undermine the comparability of banks' capital. So the balance sheet assessment will have to pay close attention to the way in which these models compute the risk weights of different categories of assets, including off-balance sheet items. And the crisis was very strong in Europe exactly because of these off-balance sheet items. That is a lot of investment in very risky so-called sophisticated financial products, structured, where somehow took place through conduits, vehicles, which did not formally, were not formally part of the intermediary, but, and were off-balance sheet in this sense. So these have to be brought in. Again, in this case, the de facto harmonization is necessary. Furthermore, in order to be fully credible and to be perceived as a confidence-building exercise, the comprehensive assessment must be rigorously designed and carried out with clearly defined and well-motivated thresholds for gauging any capital shortfalls. As I observed, one of the objectives of the banking union is to break the perversive feedback loop between the banks and the sovereign. An essential prerequisite is the presence of adequate backstops against the capital shortfalls that may emerge from the BSA. Also, to avoid the procyclical effects, clear and extensive communication of the process and its results is necessary. The mistakes of the past in the sequence of the action are clear, action taken are clear, and they should not be repeated here. The Italian banking system is an example, offers a few illuminating examples of the problems and the challenges of the comprehensive assessment. In the international comparison, Italian banks appear to have a high NPL ratio and a low coverage ratio, that is, the ratio of loan loss provisions to gross non-performing loans. Every bank has non-performing loans in its balance sheet. It has reserves against these non-performing loans. When this loan from non-performing is put out and it becomes a loss, some of it will be recovered, but some of it will not. And so we need to be sure that banks have enough reserves to cover the component which is not going to be regained and brought back. It is clear by now that the comparison across banking system is vitiated by disparities in accounting and supervisory practices, which must be taken into account in order to obtain a fair assessment. A case in point is the treatment of collateralized loans. Some major European banks do not classify fully collateralized loans as non-performing loans. So I have a loan which is non-performing, I have collateral that is estimated to fully somehow cover it, and so I don't call it a non-performing loan, even if it is a non-performing loan. I use a net concept, if you want. In Italy, loans are classified on the basis of the borrower's creditworthiness, irrespective of collateral guarantees. No, both practices are fully consistent with international accounting standards enforced in Europe. But our method, we think, makes the bank's balance sheet more transparent for investors. You may have a lot of collateral, but you are unable to really choose well your borrowers. Now, if Italian banks use the same definition as some foreign banks, their stock of non-performing loans would fall by about 1/3, decreasing their average NPL ratio significantly and raising their coverage ratio. At the same time, the rise in the NPL ratio in the recent years would be less accentuated, reflecting the sharp increase in collateral demanded by Italian banks in reaction to the deteriorating economic outlook. Now, I want to be clear here. I'm not suggesting a relaxation of our definition of MPLS, which, by the way, is broadly in line with the one proposed in the European Banking Authority consultation paper. I'm arguing that the balance sheet assessment needs to take these and other sources of heterogeneity into account. And similar considerations apply to leverage. Italian banks have lower leverage than their international competitors. Leverage is basically, rather than comparing the capital that the bank has with risk-weighted assets, with assets lumped together with weights eliminated, which means that you don't discriminate by the different assets. And in case some of these assets are very risky, but you have not computed the weights properly, then this allows you to counter that improper accounting. Now, it is known that in the case of Italy, banks have lower leverage than their international competitors, partly because of a relatively small volume of business in derivatives. And it is arguably their operational risks are also comparatively low. After all, Italian banks have not been involved in any of the serious episodes of malpractice or the market rigging schemes that have damaged the reputation of some foreign intermediaries and cost them expensive legal settlements. These and other sources of heterogeneity, which tend to bias international comparison against Italian banks, have been documented by our financial stability reports as well as by market analysts. They will have to be duly taken into account in the comprehensive assessment. I'm saying these as examples, and I will conclude accordingly. But I think it is very important because there is now, around the world, a lot of uncertainty in assessing the quality of the banking system of the euro area at large, of different nations, different systems, and so on. And this exercise is going to provide transparency and be disclosed in a way to reduce this uncertainty, which is fundamental if you want to go in the market and raise the capital which is necessary to strengthen the system itself. Now, therefore, these arguments are intended simply to support a fair approach to the forthcoming balance sheet assessment and are not meant to downplay the risks that our system faces. While Italian banks have demonstrated good resilience overall, and indeed they have been supported through public funds, the least among all European and advanced economies, and this has really been due to their sound fundamentals at the outset of the financial crisis, and I would say also to sufficiently strict supervision. The sovereign crisis and two long and deep recessions have put their balance sheets under severe stress. The non-performing loans have been rising steadily since 2008, depressing profitability and raising concerns over provisioning among analysts and market operators. And even though I have set out the reasons why we need to quickly enhance comparability among European banks, we take these concerns seriously. Indeed, we have taken decisive action to address this risk, and we are confident this will improve the outlook for the Italian credit market. Apart from episodes of malfeasance, which are relevant but are circumscribed, serious difficulties mainly concern a handful of medium-sized and small banking groups. This class of banks have been particularly hard hit by the recession, the double-dip recession, owing, among other things, to lesser diversification of risks and revenues. Additional challenges have sometimes been raised by weak ownership and corporate governance structures, which may complicate capital strengthening and adaptation of business models. And intense supervisory actions have been and continue to be taken on these banks. In some instances, special administration, which is an instrument that we use and which is not common to all countries and systems in Europe, has been necessary to allow a clear recovery and return rapidly to ordinary management. The Bank of Italy regularly reviews banks' asset quality as part of its standard supervisory activity, assessing the risk exposure of each institution. The quality of banks' assets is assessed continuously off-site on the basis of detailed monthly supervisory reports. In particular, the information contained in the Central Credit Register includes the exposure of each bank to each individual firm. This enables us to assess the consistency of different banks' classification of the same borrower, checking that non-performing debtors are not classified as performing by some intermediaries. Moreover, the Bank of Italy monitors the adequacy of loan classification criteria through extensive on-site inspections, among other things, in order to curb their forbearance risk typical of economic slowdowns. In the second half of last year, against the backdrop of an exceptional and largely unanticipated macroeconomic deterioration, we launched an ad hoc supervisory review of the adequacy of banks' non-performing loans provisioning policies. This involved simultaneous on-site inspections at 20 large and medium-sized banking groups, whose coverage ratios either were lower than average or had fallen significantly. The main findings were published in a note posted on our website, and overall, the coverage ratios for the entire NPL portfolio of the 20 group rose from an average of 31 to 43% between June and December, notwithstanding the sharp rise in the denominator of the ratio, the non-performing loans themselves, in the same period. In other words, the downward trend in coverage ratio since the beginning of the crisis has come to a halt. The intelligence gathered in the course of the review will also be used for the application of add-ons which we can impose to banks as part of what we call in the jargon second pillar capital. Our supervisory action continues. We are closely monitoring the implementation of the corrective measures that the banks were asked to adopt, while assessment of banks' assets quality and provisioning levels is still ongoing and has been extended to other banking groups. Any capital shortfalls that may emerge will have to be met through proper actions. Within the bank's perimeter, selling assets, reducing, moving dividends to capital and so on, of decisions, and with recourse to the market. At the same time, we are taking care to minimize the procyclical impact of banks' actions on the availability of credit to the economy, and this is why we have called on banks to increase their internally generated resources by curbing operating costs, as well as dividends, as I said, and executing directors' compensation. Our current assessment is that, notwithstanding specific difficulties, the challenge will be met and market concerns will abate. But the state of the banking system is not independent of the general economic environment. Action to revitalize the Italian economy and raise its growth potential is thus as important as ever. All this basically is an example of a single relatively important banking system in this process, and how we should be very serious about the asset side of the balance sheets of banks. Now, we have dealt with the liability side. During the height of the crisis, we had the problems of funding of banks. money market funds of the US left the euro area. There was a lot of uncertainty in the system, so the interbank market froze. And these have been substituted through actions on the funding side and refinancing longer term by the ECB. Now we have to deal with the asset side. And this is the way it has been dealt with in a very complicated environment, in a double deep recession, in a situation in which output fell by 7% in 5 years and industrial production by a quarter. What we want is really to maintain the level of attention and increase it, if you want, at the system at large. So the move to the SSM must not blur our focus on the conditions of the banking system. Supervisory standards and practices must be kept at the highest level of quality. And this will permit us to perform a homogeneous and comprehensive assessment of euro area banks, with full disclosure of differences in business models, but also with a common mandate to build on existing strengths and to counter and shrink the areas of weakness. To conclude, the crisis has constituted the fierce challenge for the European construction. The threat of a breakup of the euro, which was never taken seriously by the markets before, increasingly distorted asset prices across the euro area. The economic and social costs have been severe. Unemployment, especially youth unemployment, has soared. In the worst-hit countries, poverty levels have risen sharply and social tensions have surfaced. The responsible reaction of national and European authorities, I believe, has averted the worst. The recovery is now at hand, but the downside risks remain significant. If we are to seize the opportunity, we cannot relax our efforts. Ultimately, our economies must restructure to become more competitive in order to rise to the challenges of technological, demographic, and geopolitical change. We must press on with structural reform. The key to success will be a shared determination to advance towards a fully fledged European Union. In the current stage, the test of our result is the building of an effective banking union. Thank you.
Thank you very much, Governor.